this is one of our fantastic webinars with BLS aimed at juniors. So often you'll come to talks and we've got really interesting high-level information, but we've also tried to take that down a notch for the juniors as well. And this is one of those such talks, so a really good starting point. And you can then hopefully look into Helen's services for the more niche and specialist things as well. So my name is Roisin O'Dooley. I'm a personal injury solicitor at RWK Goodman in Bath, and I am also on committee for BLS. So I'm here today representing BLS, but I'm also chair of Bristol Junior Lawyers. So I know what our juniors are interested in and where the gaps are, and the things that we want to know a bit more about. And I think accounts are something that really have the fear factor for people. You don't know what you don't know, and it just feels like a massive area that people do get a bit anxious over, and we do often instruct people to help us with accounts and bits and pieces. So it's great to make a contact of you, Helen. Helen joins us from Milsted Langdon. She's based in the Bristol office today, but tells me that she's out and about in the southwest meeting clients and doing different bits of work quite often. So I would like to hand over to Helen. I'll do so in just a moment, but I'm just waiting for a few more to join us. Whilst you are joining, just to let you know, today's webinar is being recorded. Helen's kindly given permission for the slides and the presentation to be shared. So I think by the end of this week, that should be available to those of you who've signed up. And also, if you have a look on the Bristol Law Society's website, you'll be able to find a link to things. Bristol Law Society have a brand new website, so it's quite exciting to go and have a look at that anyway, and see what's on there. There's a lot more content and it's quite intuitive. So if you click on something, it will make other suggestions for you, and you can filter things quite easily. So I would recommend everybody has a look. Perhaps I could hand over to you now, Helen. So thank you very much, Helen, for taking today's webinar. I will be collecting Q&A throughout the talk, so if people could just type in the Q&A box, that will be anonymous, and Helen, I will present those questions to you at the end of today's talk.
Lovely.
Yes, without further ado, if I could hand over.
Thank you, Roisin. I am just going to share my screen. Oh, what am I doing wrong? That's never a good start, is it? Share, sorry. As you can tell, I am a novice at this, but here we go. Okay, thank you. So I am Helen Gregory, and I'm a director in the forensic accounting team at Milsted Langdon. Today I'm going to talk to you about accounts, and hopefully I won't make it too complicated and confuse you even more. But the idea is just to give you an insight into some of the issues that I face or I look at on a daily basis. So as Roisin said, I work at Milsted Langdon. We're a regional firm based in the southwest. We've got offices in Bristol, Taunton, Bath, Yeovil, and we've got an office in London in Liverpool Street. We're multidisciplinary, so we have accounts, general practice area, audit, tax, which is very useful because accounting standards change regularly. So it means that I can keep up to date, but without having to still be a specialist in that area. We also have insolvency and corporate finance teams, and as I said, I'm part of the forensic team. The firm has 200 staff, at least 200 staff, and 21 partners. So I have been doing this for a fair few years. I spent 5 years in audit, qualified as an auditor, and realised that it wasn't going to be enough for me and the rest of my career. I regularly give evidence in court and tribunals, and almost all my work has that element, or at least the risk that if I write a letter of advice, at some point it might have to be turned into a court compliant report and I could be in the box. That obviously puts a different onus on the sort of work I do, in that I always have to be careful in the opinions I make are actually based on facts, and that the advice I give can be backed up, because there's always some barrister and clever solicitor that can pull holes in what, well, that's the risk, and pull holes in what we do. So two recent examples of giving evidence. Last summer, I gave evidence in the criminal court at Bristol Crown Court. And this involved what started off as care proceedings, quarter protection proceedings. So back in 2017, I was called in by a firm of lawyers to help assist a lawyer in her application to the Court of Protection. What we found was that the daughter and her husband were steadily spending her mother's money when she was actually in a care home with Alzheimer's. The husband got convicted of stealing her money, and that was a great result for us all. But it did take from 2017 and two trials that didn't go according to plan before we actually got there. So moving on to accounts. So when we use the word accounts, it can mean many different things to different people. You ask for an opinion and you'll get loads back of what the term accounts actually mean. Looking at it, we can have everything from projections, which are in my opinion, are the least reliable ones, right up to audited financial statements. And these are typically for the bigger and largest companies. And they are probably the best sort of accounting evidence you're ever going to get hold of. So looking at them in a bit more detail, audited financial statements, these only apply to the largest companies. It is possible for shareholders to request that the accounts of their company are actually subject to an audit, but it isn't necessary. Largest companies also mean that the full financial statements will be filed at Companies House. And by full, I mean profit and loss account, director's report, notes to the accounts. You might also get other bits and pieces filed with them. For listed companies, filing accounts, the accounts that they make public, are often seen as a bit of a PR exercise. So there'll be a bit of blurb at the front which will tell you how fantastic the company is, what its green credentials are, what this does, how it helps and gives back to the community, and all those sorts of things. And it can be a big weighty document. And the issue for auditors is if there is a figure quoted anywhere in that set of financial statements, whether it's part of the accounts or whether it's part of the blurb, they have to check that it makes sense in the context of the actual figures that they're reporting on. So an audit is an independent examination, and it's done by a firm of accountants. Sorry, they don't have to be chartered. It's chartered and certified, but they have to be registered auditors. Not all accountants are auditors, and that it can be a big difference. It's quite expensive to be an auditor because you have to have a registered individual, responsible individual, sorry, and it has to be registered with the regulatory bodies. You need to have different PI insurance. You need to keep the training up, compliance, all those sorts of things. And auditors will attest to the truth and fairness of financial statements. That doesn't mean they're correct and they're accurate. It means that they comply with what's known as UK GAAP. GAAP standing for this is where I get so used to using terminology and jargon, I forget what it actually stands for. UK GAAP. GAAP stands for Generally Accepted Accounting Principles, and it's the framework over which guides all the financial statements that are put together in this country, in England and Wales. And it has to be said that it's England and Wales, although we now do international standards, which means that if you look at a set of accounts in the UK, it should be similar to those in France as well. And they report to the shareholders. As they don't report to the directors, they are instructed by the shareholders, and that's whom they report to. Okay, so moving on. Sorry, I'm just shuffling bits of paper here. That was my mistake. Okay, so the key words in this statement, this is the scope of an audit. So it involves giving evidence about the amounts included in the financial statements, sufficient to give, and the key word to the phrase here is reasonable assurance, and that they're free from material misstatement. That reasonable assurance means that they do not look at every single figure. They only look at what auditors judge to be a sufficient sample. So I'm in the process, for example, of being instructed to look at, and not audit, technically audit, but to do a review of a purchase ledger system. There are, I don't know how many different items. I think we've got up to about 3,000 different items on this purchase ledger. Do I pick everyone? Is that going to make a difference? Well, no, it probably isn't. So what we're looking at is taking a subsample, making sure that works. And therefore, if that sample works, we can assume that everything works. It is an assumption, obviously, and it could be proved wrong. One of those subsample doesn't work, then we have to expand the sample size, and it gets bigger and bigger and bigger. And that's the way it works, is we have to get that reasonable assurance. And the next key word is phrase is material misstatements. That doesn't mean it's true, and it doesn't mean it's correct. And what is material in one company to one set of accounts may not be material and significant to another company and a different year. So, for example, directors' remuneration has to be precise. It's always been one of those things. It has to be included in the accounts, in the financial statements at the exact figure. But if you think of turnover, let's say you've got turnover of 10 million. Does it really matter if it's £50,000 out? Now, to you and me, 50,000 is a lot of money. But if you've got turnover of 10 million, is that going to change your opinion about the position of the company? Probably not. But if you get down to profit, and profits, let's say only 25,000, then, well, that will make a difference, because if it's £50,000 wrong, it could be a £25,000 loss. So everything is based in context. And if the auditors think there's something wrong with the figures, they have to tell management, and management should make a judgment in agreement with the auditors of whether there should be a change to the figures. If there is a dispute between what the auditors want and what the directors and shareholders want, then the auditors will eventually have to resign. And it's quite a big thing to actually go through that process, having sat there with directors in the past who have wanted the accounts to portray a particular view, and me, thankfully, being just a junior manager at the time, letting the partner do the talking, we had to resign. It wasn't something that we could do, because that would have been a breach as far as we were concerned. So accounts and audited accounts are always based on the principle that the company is a going concern. And that means that it will continue, it is expected to continue in business for the foreseeable future, which is in reality 12 months from the date of the signing of the audit report and the director's report. So those two documents, the audit report and the director's report, which are contained within the financial statements, will normally be signed on the same date, and the audit review for going concern will be from 12 months from that date. This means looking at projections going forward as to whether the company is still likely to go and keep going. I currently have a case where I've got 3 companies, all reliant on intercompany balances. It's a great big massive group with bits owned wholly by one company, 27% by another company, and it's all interrelated, and that makes it really hard to decide whether the subsidiary we're looking at, which is right down the bottom of the chain, was actually a going concern, and it all feeds back to whether the parent company is going to keep giving it money. So we've looked at briefly at large companies. So small companies are the SMEs of this world, the companies that you and I probably deal with on a daily basis, particularly in the Southwest. So these are the criteria for a company to be considered small. It has to have 2. It has to have either annual turnover of less than 10.2 million, on the balance sheet 5.1 million, and less than a certain number of employees. It doesn't matter if those targets are breached in any year. What it does matter is that if it doesn't fall back the following year, so over a period, it has to have at least 2 of these 3 criteria. So small companies don't need an audit. So you don't have an audit opinion. You have no independent financial review, no independent examination, and no firm of accountants saying that they're true and fair. Companies House don't necessarily require a director's report. They might not need a profit and loss account, might just be a balance sheet and limited notes. they're not a lot of use to people who get them off Companies House. There's a lot that can be hidden, or not hidden, but not available to the casual observer from getting a copy of these statements. But they do cover most SMEs. If you, for whatever reason, are involved in litigation with one of these companies, you will find that the accountants will have prepared a profit and loss account. That is so that it acts as a check on the balance sheet that's being produced. I won't go bore you with details of double entry bookkeeping, but it does mean that the balance sheet plus the profit and loss account should equal the same figures at the end. I won't go into, as I said, I won't go into all the details, but it acts as a check. So there will be one that's been prepared by the accountants. And management will want a full set of financial statements. How can it know how it's doing if it doesn't know what profit it earned in the year? They need to sign off. This is the big thing about companies. The responsibility of keeping books and records lies with directors. That's not the role of the accountant unless it's been outsourced. But even if it's outsourced, it's still the responsibility of the directors. They need to have confidence that the figures that are produced in those financial statements are appropriate. Accounts can be prepared in-house. You don't need to go out to an external firm. You don't even need to be a chartered certified accountant or a member of one of the other institutes. The role of the accountant can be extremely limited. It can just be looking at bank statements, a few invoices, just a bit of checking to make sure that you think the figures are okay. It doesn't have to be the detailed work that comes with an audit. The other thing is that when doing audited accounts, the duty is to the shareholders. When you're doing small companies without an audit, the duty is to the directors. That might just be a sort of a minor change in emphasis, but you've got, the directors are actually the pay masters, if that makes sense. They are the ones that will probably appoint you, and that appointment is then verified by shareholders. And the duty of the accountant is not to be associated with misleading information. So again, it's back down to what's material, what's different, and all those sorts of issues. So moving on from financial statements, management accounts. These are normally produced not by SMEs. These aren't normally produced by SMEs. These are normally produced by relatively sophisticated companies. We do a lot of management accounts preparation for some of our clients, which means that we take the information that's on their ledgers, on their accounting software, this is my understanding, and it won't be what they actually do. Press the button and out comes the profit and loss account and the balance sheet, which should mean something to management. It will give them an assessment of where they are in terms of turnover, what they've earned this period, what's their costs, all those sorts of things. And as I said, they're best prepared as soon after the month end as possible to be most effective. So they can be shared with banks. They might normally just for in-house, but they can be shared with banks. And you've got to therefore be aware that they may contain a bit of bias. They may not include everything one would expect in a full set of financial statements. You'll often find that there's no depreciation, no corporation tax. Bits will be missing, but missing in the context of what you would need for year-end accounts, not missing for what you want for management accounts, because there's no legislation, no rules about what should be included. They tend to be not very reliable. They really tend to be kind of ad hoc. You can maybe take the top line level of turnover because, for example, if you issue a sales invoice, that should flow through to turnover in your books and records, which will then flow through to turnover in your accounts. So that should be reasonably correct. Your bank account should be reasonably correct. Other pieces may not be. But saying that, I just valued a company that's not too far from where I'm sat today, and they were absolutely amazing, their management accounts. They almost reconciled to the penny. Almost, they were too good, that made me begin to wonder what they were up to, because it's just me being suspicious as a forensic accountant. But it's very unusual for that to happen. But I can't fault the finance director. I thought it was great. Okay, so projections. These are prepared generally in-house. I suspect you've all got billing targets. The billing targets will then form the projections, the forecast for the firm as a whole. They've got an idea, the partners then will have an idea as what the profit's going to be at the end of the period. If you are valuing a company, theoretically, projections are the best basis for valuing that company, because after all, when you're buying a company, the value of that company is the sum of its future earnings. But I don't know many SMEs that produce projections. I don't know many companies. It's very rare for smaller companies to actually prepare anything. They might, you know, the number of business people I speak to, the owners that will go, oh yes, turnover is going to be 10 million next year. How are you going to get that? You're only producing 5 million this year. Oh, well, it'll be 7.5 here and then that and then that. And you break it down and they haven't. It's just a figure they've come up with, maybe for the bank. Maybe that's what they've been telling their mates down the golf club or something like that. So it can be, I wouldn't actually put much trust in them, but they could be really useful if, as I said. So I actually valued a company that where the husband was a 46% share owner. So he wasn't a 50-50, he wasn't the only shareholder. Going through the divorce proceedings, my client, the wife, said, he's just feeding me a load of rubbish. I don't believe anything he tells me. He's got control, he's got this, he's got that. We got through a board pack. I suggested to the solicitor that she ask her counterparty whether we could have some board packs of these management accounts. And I don't know, I must have got 50 pages through for each month. So they had itemized lists of all the jobs they'd won, all the work they'd undertaken, how far they'd got on this infrastructure project, what were they expected, how they'd done to profit for the forecast for the period, how the forecast had been reforecast to the end of the year. It's just like, this is a proper company. This is really well done. The husband, who was the sales manager, had no control over these figures whatsoever. And it was the confidence then to go back to the wife and say, look, he might be spinning you a load of lies in this area, but in terms of the company, this is the sort of quality of data he's preparing. So take that and just have some confidence in this information. Looking at measures of profit. Profit is another term, like accounts, that can mean many different things to different people. So taking you through some of them. So profit after tax, that's at the bottom of the back of your profit and loss account. It's almost the final figure, or it is these days the final figure that appears on your profit and loss account. From that, you will then have dividends paid, generally, out of those profits for the year. But we'll start with profit after tax. Then obviously profit before tax, the only difference being the tax charge for the year. And that tax will include the corporation tax on the earnings plus deferred tax. Deferred tax is a whole different topic for a whole nother day if you're interested, but it is quite a discrete area of taxation. It's basically trying to assess what profit could be payable in the future to give you a balancing figure over the period of the life of the company, rather than just suddenly sell something and you got this lump sum. Then after that, we have earnings before interest and tax. So the interest in this case will be interest on loans and overdraft. Could also include some finance charges on leases, but generally it is just interest. It's not things like bank charges. And then and those three figures will all appear on the face of the profit and loss accounts. But the one that, as a valuer of companies, that I'm most interested in is EBITDA. So that's where you ignore depreciation and amortization. The reason for ignoring depreciation and amortization is then that takes out whether you own assets, whether you've got what's called intangible assets, you've got property, you've got machinery, all those sorts of things. It takes that out of the equation. All you're looking at then is simply the earnings from your operations. And typically, that's what a valuer would want to start with. But as I said, it does take out how, and ignoring interest and depreciation does ignore how it is actually funded. And valuation theory dictates that because of how multiples work, if you value a company based on its profit before tax and on its EBITDA, you should get the same answer. And if you don't, you then need to look at how the company is actually managed and run, and what the differences are in your calculations. You know, we do it as a test all the time to make sure that we fully understand what we're looking at. Okay, so looking at what can be manipulated, what can typically come across my desk, either as one disgruntled party tries to fling a mud at the other side, or where just through experience are the key areas that I'll always look at. So one of the underlying principles of financial statements back in my day was that they were prepared under the principle of historic cost accounting. So if you saw stock in the balance sheet, that was the price that was paid for it. If you saw a car on the balance sheet, that would have been the price it paid for. But saying that, there are all sorts of adjustments that can be made and mean that things are actually are included at their fair value. So, for example, if you've got a company that rents out properties, that could be included at market valuation. There should be a note to tell you that in the financial statements. But then if you've only got abbreviated accounts from Companies House, you may not know that. And that valuation could be a director's valuation. It doesn't have to be done by a chartered surveyor. You may also have other issues. You may have things like goodwill, which is recognised on the purchase of another subsidiary. That's now subject to what's called an impairment test. So each year the directors are supposed to sit there and go, what's the value of this asset that we bought, this subsidiary that we bought 10 years ago? Does it still have a value? Are we still getting benefit from that purchase? Stock is an area that's quite, I won't say open to manipulation, but there are different ways for accounting for stock. If you've got let's say you've got a company that's a distributor, what it does is it buys and sells items of stationery. At the year end, in theory, the owner of the business, and possibly with their accountant, will go around to count how many different pens they've got, how many pads of paper, how many staplers they've got, and all those sorts of things. Apply a value of each pen, pad of paper, staple, and that's the value of the stock. Multiply it all through, that's the value of the stock. That's great, that's fantastic, and that does still happen. But what happens if it's a manufacturing company? Can you apply the cost of labour? So if you think if you're making a car, the value of that car when it's finished could be, let's just say the value to the company could be £10,000. But the components that they've just bought in are a couple of £1,000s. But you've got labour, you've got a share of the overheads in running that factory. Those can all be added in to come to a cost at the year end. And then you've got issues of, is this car fully complete? Is it half complete? Has any work been done at all? Is it just sat there as raw materials? And that will all come into the valuation process. And then you may have a property development company. Now, they can be easier to value simply because generally, in order to get paid, if you're building, I don't know, say 100 houses on a piece of land, you will get a report from the chartered surveyors, who will say the value of this property, this development so far is X, and then that's used to get a payment from the end client. But that's not necessarily so. And I suspect you, like I, see many different companies that have the same stock value every year. Now, if it's not subject to an audit, the accountant will probably just phone up their client and go, I know you run a hotel business. How much stock do you think you had in at the end of the year? Oh, 10 grand, 14 grand. And I've just done a company where, looking at accounts for 3 years, the stock value is the same each year. Do I actually believe that stock figure? No, I have no idea whether that's true or not. It's just something I can raise with the client and just say, look, be careful, because 10 grand's worth, if you're running a pub, I mean, I've no idea how many bottles of alcohol that could be, how many pints of beer in the cellar, how many kegs, how many packets of crisps, how much food in the fridge, in the kitchen. Directors' remuneration. So directors who are also shareholders of a company will typically be remunerated in a tax efficient way. That's changing, or could be changing, because there's new tax legislation coming out. But that used to mean that what you'd get was a minimal salary, probably about £10,000 to £12,000, and then the rest of it would be dividends. So if you're looking to value a company, that's not what you pay a third party to come in and manage it. So you have to look at what you would actually pay. And there are various resources that we would go to find that out. And that's obviously not, you know, you look at the pure salary of £12,000, that's not what they're living off. It's also the dividends. Are there other benefits in kind that they're getting? It's not unusual. I've got a client at the moment. Every month there's a membership that goes out for David Lloyd. It's corporate membership for the company. The owner takes advantage of it, but the same so do the staff. That could be considered to be a benefit in kind. It could also be considered a cost and a bit of a perk that a third party coming in to buy that company wouldn't necessarily carry on. It goes the same for golf membership. I mean, I know when I used to work out of a certain office for another firm, that all the business was done on the golf club, which was kind of on the golf course, which was kind of hard given I really didn't play golf and I really had no interest and certainly no ability to play golf and hold my own on a golf course trying to do business. But it is part of doing business, and it still is. And again, what about cars? Would you give if you were coming in to manage a business, would you expect to be given a car? If you were given a car or car allowance, would you expect to get a Ferrari? I've known clients where they've had Ferraris as a company car. Seriously? You know, you just think that's not what you need to get from A to B these days, especially not if, like me, you work in Bristol. The other issue is whether family members are also being paid within the company. It isn't unusual for perhaps, let's say the business is run by the husband, perhaps for the wife to be the company secretary and she receives a salary for that. I've just finished valuing a farming business where the father owned and managed the business. He got a minimal salary. His wife got a minimal salary. The children, who were adult children and had left home, they did not get market rate. And I just, you know, sometimes you get them they overpay their kids for not working in the business. But these poor guys were working within the business. And Dad said, that's because I've told them it's their business when I die. And, you know, they got to stick with it or move on. And I think they were moving on because they didn't like the dad after the divorce. Other expenses that could go through. I had a wife, this is one of my first wives I've ever had that's actually been in floods of tears in a meeting with me. And she was absolutely convinced that her husband was using company money to stay in a hotel round the corner from the office so that he could see his new mistress. I don't know how true that was. Was it going to change the value of the company? If he was doing it once a week, once a fortnight, once a month, it's never going to get picked up either by the accountant or the auditor. He had a valid excuse. He didn't want to drink and drive to go home after entertaining clients. It's very difficult when it's that sort of scenario. You and I might think it's wrong, but you know, thinking it's wrong and actually going, it's a bit too dodgy, I'm going to adjust for that. It can be difficult. Directors' loan accounts, or DLAs. This is probably one of the most common issues that I get asked to look at, and it's one of the areas we're always very keen to follow up. There is nothing wrong with the directors having what's called a loan account with the company, and it is normally the small owner managed businesses where the line between the director and the shareholder is very, very blurred. It could be that the shareholder director goes out and buys stock using his personal credit card. He will then expect to be reimbursed by the company. It could be that he goes to the next shop to buy flowers for his wife and pulls out the company credit card. Similarly, the company should not pay for flowers for his wife. So it's then making sure that at the end of the year that this is all sorted out every time the invoice is put through the company, or he wants to take money out for reimbursement. This is what is looked at by the in-house accountant. It may also, generally what happens is when you take a sole trader and you incorporate the business, there is a bit of goodwill when he incorporates the business, that then represents the capital that the shareholder director has invested in that company. and it can also be actual funds that the shareholder director has paid into the company to get it going in the first place. During the year, normally directors will take drawings. They won't be paid a salary. They'll take drawings during the year. Maybe they receive £3,000 a month at the end of the year. And I would suggest this should happen in month 11 of the year rather than month 12. The shareholder director will sit down with their accountant and they'll do some maths. They'll work out the best way to reflect that on the individual's tax return and through the company books and records, so that it's correct in the company and also appropriate in his actual personal tax return. Because the last thing they want is a tax investigation because they get it wrong. And the rules have changed. I'm not sure whether you're aware of this, but the rules have changed that dividends have to be declared pre-year end. So it's important that the director sits down with their accountant before the year end to sort that out and get it all the paperwork properly done. So you can also have overdrawn director's loan account, and the term overdrawn, can confuse people. It often confuses people because by being overdrawn, it means that the director owes money to the company, whereas normally it's the company that owes money to the individual director. The HMRC will treat that as remuneration at the year end, so it needs to be sorted before the year end, so that it's, and by treating it, sorry, let me get this so I don't confuse you. If it's treated by HMRC as remuneration, as it's because it's overdrawn, then the company has to pay tax on it. If the company pays tax on it when that loan account is then back being funds that the company owes the individual director, they can then reclaim that tax, but that can take a couple of years and is quite a convoluted process. So overdrawn directors' loan accounts, they're not nasty. They don't mean anything particularly bad. It just means that the director needs to get their financial planning in place before the year end. And it's not unusual. It's one of those things, but it does cause consternation, particularly to maybe solicitors looking in valuations. The one question I will always ask when looking at a company for whatever reason that has a loan account is, how has the loan account, what's gone through the loan account? What is the director putting through that isn't just salary? Some companies are very clean. Some is just like, they'll start the year at zero, they'll start drawing throughout the year, and then at the year end, it will be taken down to nil. Other times, we'll have clients that will have school fees going through. We'll have the golf club memberships. We will have personal expenditure. There is nothing wrong with that as long as it is sorted before the year end and it's obvious and it's evident, and there is nothing that's going to cause HMRC, whoever else is interested in the company, to get concerned. We've just had one where we looked at, it's slightly different, but also on the same sort of area. We had a dentist practice that the husband was putting his legal fees through the business, and the wife had gone, she also ran the dental practice with the husband, and the legal fee suddenly jumped by something like £50,000 year on year. And she realised that he was putting the costs of their divorce through the books. And as I said, that isn't wrong, but it should have been taken out of legal fees and put to the director's loan account. The company should not pay for the expenses of those divorce. The other things he was also putting through was various rents on his own personal property that he was having to rent now that he'd been kicked out of the matrimonial home. That was going through the books and records. And when we had a meeting with husband and wife, the accountants were there. And it's one of the few times when I had real sympathy for the accountants, because you could see them on a Teams call trying to catch the husband's eye, going, right, if I come back to you with these questions, are you going to answer them and come back to me directly? And he went, yeah, I'll do that. And then the accounts didn't come through the month they were promised. They didn't come through the following month, and they were 6 months late. And you could almost feel that accountant's pain in trying to get the information out of the husband. I just hope that they charged the right kind of fee, because often what I will see in litigation is that the fees are not commensurate with the work that the accountant actually undertakes. I've just done a fraudulent trading case, for example, where the auditors, the firm of accountants went from auditors to accountants, which is fine. That happens all the time. The thresholds got changed and the company didn't meet the need for the large company. But what it meant was that they didn't actually spend that much time looking and understanding the business. The partners changed as it went from audit to accounts prep, and the new partner just didn't have the experience and didn't have the capacity to look and understand, because what they had was, it was a travel agency, so they took deposits of people, and it was those deposits that were spent by the company. They were being drawn down too quickly, and that was where it went wrong and why we ended up with charges of fraudulent trading. Okay, so provisions is another area. So when I was a trainee accountant, it used to be a rule that if a company was going to have a bad year, it was going to have a very bad year. So this meant that if it was already loss making, well, you might as well reduce the value of stock, because if you reduce the value of stock at the year end, then it'll make more profit next year. So you have a bad year this year, then you'd have a much better year next year. You'd also do the same with trade debtors. You'd look through how much was owed by various companies, and you'd write off various amounts this year to reduce your losses, to make your losses even bigger, so that next year when they did actually pay, you could then boost your profits. So that has tightened up, and so the rules and provisions has changed so that they can only be recognised when there is a present obligation as a result of past events, and settlement is expected to result in an outflow of resources. So let's say we've got a company with a December year end. The directors are sitting around and they're sitting in December and going, we're not doing too well. We're going to shut that factory in Bristol down. We're going to close it all down, make everybody redundant. And they go, oh yeah, that's a good idea. Let's do that. In my day, you could put through the cost of making everybody redundant, of the cost of clearing the factory, of terminating contracts early. You could put it through all in this year. But if there's now you've got to have an actual formal plan, and that formal plan includes putting names on the redundancy list. It isn't just, oh, we'll close that and we'll redeploy some people. That would be like shutting this office down in Bristol and going, Helen, she only works out of Bristol. We're going to make her redundant. She's definitely not going. So I'd also have to be told on a consultancy basis and all that sort of thing. So it's changed an awful lot. So as a result, you will see less provision. So it could be that they'll still be there for, say, like some of the bigger companies that are going through formal restructuring, or for examples like Marks and Spencer's in Broadmead just closed. I don't know whether that would have included a redundancy provision. It may well have done. But just be aware that provisions will actually make a difference, and it could be that they're trying to flatten out profits year on year. Could be that they're trying to have a very bad year and then following year a very good year. And then non-conterminous year ends, basically that you're looking at different companies or different sets of financial statements for the same company that don't all have the same end date. Now, there's various reasons that will happen. In some countries, and I think France is one of them, where every company has a December year end. I think that's right. I could be wrong, so please don't quote me on that. But for example, if you work in retail, or you've got a shop that's in, a business that's in retail, you would expect to be cash rich and have low stock at the end of December. Or typically that's what we did before online shopping and Black Friday, Black Thursday. Sorry, which one is it? Black Friday? Yeah, sorry, I've got a colleague in here and he's not really listening. But Black Friday came in. So you'd expect various flips throughout the year. But in the run up to Christmas, that's the best time of year. You would actually expect there to be a fantastic set of results that you want published to the stock exchange at the end of December. Great, that makes complete sense. Okay, so you've had a bad year, or you know you're going to have a bad year. You can apply to Companies House to change your year end. So suddenly you go from December to June. You've now got an 18-month period. You can do that for do that for 1 year. Yeah, that looks fine. It's kind of smooths out the rough with the smooth, with the rough with the good, and it makes it look a whole lot easier. You've just had one very bad year and you're managing to disguise those results. And then in a couple of years, you change it back so that you've got back to your December year end. It's just one of those things to be aware of. I was looking at recruitment agents, not obviously because I want another job, but because I was looking at their accounts to work out what discount factors they used when they valued their own acquisitions. And it was interesting to see that one company had a June year end and another company had a December year end. Firms of accountants will often have April year ends because that's held over from partnership roles. You might also find the same with law firms, but there's no need to have that so much when you're a limited company. So it does make comparisons harder, and that's really one thing to be aware of, just to make sure that you are looking at the same figures and the same things year on year, and it does make it a lot more difficult. So I think, Rasheen, I'm just about done. I'm just about on time. So
yeah, you've done an excellent job of keeping that to time, Helen. Well done. Fantastic. That was really interesting. Thank you. I like the way that you broke it all down and gave us some of the terminology that we've probably seen countless times and not really fully grasped. So thank you for that. I have had a couple of questions in. There is time for more questions than I do have. So if anyone sort of thinks of a question now or would like to ask something following on from one of the questions that I read out, please do type something in the box. That's the Q&A box, and then you will be anonymous. So I suppose a question that I had was, where do you receive your instructions from in terms of law firms? So is it certain departments that you tend to see more instructions from, or certain discrete tasks that you tend to get given? Perhaps a bit of background on that might help our juniors to understand how they could use your firm services.
It's really, really varied. When I joined Milsted Langdon, it had a very good matrimonial practice. So we would be appointed as single joint experts. My colleague would get his instructions from 2 solicitors based typically in Bristol, perhaps in Somerset. And then over the years since I've been here, it's widened out. So it's not necessarily from the locality. It could be London, could be the Midlands, but that was the base of Milsted Langdon's instructions. I came in having done a fair amount of investigations work. So in my time, I've raced around the country in a hire car, trying to find people acting as shadow directors, working for the Serious Fraud Office. I was involved in a generic medicines inquiry. I came with those investigation skills. So, for example, I do legal aid work I'd love it. I was about to say for my sins, but I love it. Not the best for billing because you're on legal aid rates, but I find it absolutely fascinating. So it'd be someone that's having under proceeds of crime proceedings. It could be something weird and wacky. One that's been in the press recently has been a couple not too far from the centre of Bristol who went up to Manchester, went to a certain shop, bought loads of counterfeit clothing, brought it back to Bristol and sold it on eBay and Facebook. And they didn't realise they were committing offence. And because they were selling counterfeit clothing, and I was instructed to try and help them understand and to come up with alternative calculations, because they'd made about 10 grand in profit over 3 years, and the prosecution were going for $1 million because that was the value of the stock had it been genuine. So we do litigation, looking at the value of companies, just in general litigation. We do personal injury claims when some earnings are unsure and we're projecting into the future. Absolutely anything. Sorry, I could ramble for hours. So
no, that's very interesting, I think, because if we've got trainees on the call who are moving between different departments, or we've got people that are new to a department, it's quite helpful for them to kind of see how it could all work and how your services could play into what they're doing on a daily basis.
And one of the things is we'll often get asked, which can be quite frustrating, is, do you think you can help me with the best? And I don't mind looking at a set of accounts saying, you should instruct an expert on this. But if it's a matrimonial case, then it obviously precludes me from being the SJE, because if I've looked at it and been asked by one set, then I can't do it. But that doesn't mean that I won't then handhold a solicitor who's trying to undermine the husband's valuation, for example, and try and get a higher valuation for the wife, or vice versa, or just even look through the Form E and see what we can do.
Yeah. Okay, thank you. That's very helpful. I've got a couple of other questions. What is the most important element of accounts for lawyers to understand? So I suppose before we pass on to you, what do you think, or several elements perhaps, it's really essential for us to grasp?
I'd like to say it's a black art. It's all mystical and you're never going to understand it, so you need someone like me. But actually, it's the more you do it, the more simple you see that it is. And it's often phrases like amortization, depreciation, that you may not understand what they are. And it's quite difficult for, say, someone like me who's done accounts for so long. It was interesting. My husband was a trainee accountant. That's how we met. Yeah, sad. But he doesn't understand anymore what I'm talking about, because his life, he's now in IT. So his life's gone one way and mine's the other way, and I still live with it. What you really want with most companies is what cash is in the bank. That's key for solvency. What you want to know is the sales it's generating. I had a case where I've just submitted the draft report on it, where the client says, oh, it's their pet accountants, those fraudulent accountants in Manchester. And it's just like, well, you're regulated by the Institute of Chartered Accountants. Yes, you may, I'm not saying everyone is crystal, clear and everything else, but fraudulent, I can't go with that. And it was also, he was referring to an insolvency practitioner as being Ben, and he's quite a well-renowned insolvency practitioner. And it's just like, no. So it's not a black art.
Yeah.
Just the more you do, the more comfortable you'll be with them. And we are used to having silly questions asked, because when people join forensic, they don't know what CPR means, and you forget the basics. So just ask.
Okay, that's great advice. Thank you. Another question that I have: do you see any common mistakes when it comes to using accounts, and how would you recommend avoiding them?
Google terminology to start with. So if somebody says to you EBITDA and you don't remember what EBITDA is, just Google it. And I know that's really bad. I do it with legal terms. I do it when I'm trying to write a report and I can't put it into the right words. But common mistakes is typically to perhaps confusing profits and losses and assuming that a company is insolvent because it's got negative, or it's got net liabilities. It's a negative figure on the bottom. It's got to be careful. You've got to be careful when reading them. So I would just, reader beware. As I said, you can hide a multitude of things. And as I said, I promised I wouldn't go into double entry bookkeeping, but I'm not going to do this, but they're equal and opposite entries. And if you want, you can swap them around. So it doesn't have to be a profit. You can put a loss. The opposite to a loss is an asset. Yeah. So you can hide things. So just be aware that of various pitfalls. But the most common area, as I said, of people being worried is the director's loan accounts. It really is. It's typically the area that everyone gets, oh my God, he's stolen from the company. Yeah.
Okay. That's very helpful. Thank you. Helen, do you have some contact details for yourself that you want to put on the screen?
Not to hand.
No,
my email address was on the first page. And you can find me if you just Google Helen Gregory accountant. I think I'm the only one that comes up. Brilliant. And also your slides will be circulated. Yes, that's right. Correct. Okay. Brilliant. Well, I don't have any more questions. I have put out a little plea to see if there are any more, but I think that's us. So thank you very much for your time. Thank you for taking us through that so patiently. I do like your attitude and approach to doing this. So I would enjoy I'm sure I would very much enjoy having a conversation with you about someone's accounts. So hopefully we get to do that at some point.
Yes, thank you very much again for coming along on behalf of BLS and Milsted Langdon, and we hope to see you again soon. Thank you.
Pleasure. Thank you.
Thanks everyone who's attended. You should have a copy of the slides and the presentation by the end of the week. And don't forget to check Bristol Law Society's website for future upcoming events. Thank you.